Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Let's get to the panel. Joining us now is Mohamed, El-Erian of Queen's College, Cambridge, alongside BlackRock's Jeff Rosenberg. Gents, great to catch up with you both. Mohamed, first to you. You've had a bit of time to pore over this one. What's the big one for you?
So I like to look at this in four ways. One, the very narrow sense. This is a really strong report on the demand side, not on the supply side, on the demand side, but strong in terms of demand for employees, strong in terms of wages paid, etc. It does close the door on a July rate cut. I think that is it, almost regardless of what the CPI number says next week. But then step back and ask the question of reconciliation with other data. And then the story gets a lot more interesting. We have this situation where the backward-looking data is strong, the forward-looking data is weak. So we've got to sort of reconcile these two things, which leaves us to the point that Lisa raised, which is, what is your view of the economy? Because if you don't have that view, you're going to continue to get whipsawed for quite a few months, and you're going to miss windows of opportunity that are really important.
Yeah, Jeff, this is really difficult. It's a question we both asked Mike McKee. Can you reconcile this data this morning with the data we've had all week? First of all, your view on this morning's number, and second of all, to Mohamed's point, can you reconcile this with what we're looking at elsewhere?
Yeah, a couple of things. I mean, the big market reaction is not only because this is a strong report on its own, but it is stronger than what people were expecting going in. And there were two things that were kind of undermined relative to those expectations. Number one, as Mike was talking about, the seasonal flows expected to push down. We overwhelmed those. And then there was a pull forward argument around warm weather, and the construction number that Mike just mentioned was very strong. So you didn't see either of those things. Mohamed mentioned closing the door on July, opening the door or reopening the door a little bit wider on the debate about whether or not policy is indeed as restrictive as the Fed thinks it is. And this is a little more evidence to bring that debate back into the fore, that you have the big financial conditions easing that's offsetting the tightening. And we may not be as tight as we think we are.
Mohamed, I'd love your thoughts on that at a time where your framework does expect some more significant weakening. Does this data change that to you? Does slamming the door on a July rate cut seem reasonable to you, or are you concerned that this is basically the wrong signal at a time where what comes next looks different than what came before?
Look, it's reasonable for a Fed that is overly data dependent. There's no way they can cut or signal a cut in July with this data. They would have to change their reaction function and be public about it, and I don't see the Fed doing this. So that's why the door is shut. Now, should it be shut is a much more interesting debate. You know my view. We are in a weakening economy. There are no spare tires to speak of anymore. There's no pandemic savings. There's no huge new fiscal impulse coming. There are no spare tires in this economy. So if you get it wrong, and you weaken too quickly, it's going to be a very difficult mistake to correct. The problem is, which is the other bit of my view that you know, is we are living in a secularly inflationary world. Secularly, inflation is going to be higher because of all the transitions going on domestically. We no longer talk about liberalization, deregulation, fiscal prudence. We talk about trade restriction, we talk about industrial policy, we talk about fiscal irresponsibility, and globally, we talk about fragmentation. All that means a more inflationary world, which then raises the question as to what should be the right inflation target. So if you put all this together, it does shut the door for this Fed, but it will not shut the door on a very active debate that's going on that tries to look forward, not back.
Well, we'll get to Jeff in 1 second, but Mohamed, just to follow up on that, are you basically saying that the chance of a harder landing increases the longer the Fed does not cut rates, even if it appears strong on the surface?
I do, because I focus a lot on the forward-looking data. and that is weakening significantly. So yes, that's where I am. But I understand that if you're data dependent, there's no way you're going to come anywhere near my view, because you would have to completely change your paradigm.
Jeff, would you agree with that?
Well, I think there's a little bit of a segmentation going on in terms of where is interest rate policy biting. And it is in the lower end of the consumer side. The flip side of that is the wealth effect, right? This is a Fed that has basically said, if inflation is stronger, if growth is stronger, we'll just wait. They've given us a very asymmetric outlook with regards to their reaction to their data dependence. What that is done is basically given the green light for financial market conditions to be very easy, and the transmission of that into the economy is a very strong wealth effect for the predominant sources of where most of consumption comes from. So you do see the weakening that Mohamed's talking about, but the weighting of that weakening, I think, is less. And so, yes, growth is slowing, but it's slowing to a level that is still well above trend. And so you don't get as much of the constraint and the push down on inflation. The Fed is basically saying, we're okay with that. And I think that's why you're pushing back with this data today on this notion of we're really restrictive. I'm not sure they're as restrictive as they think they are. And the policy of asymmetry to data reaction is kind of pushing against that by pushing up or easing financial conditions.
If you are just joining us, welcome to the program. 14 minutes ago, a blowout jobs report, a big monster upside surprise. 272 is the number, 180 was the estimate. Two standouts here, not just the headline number, also wage growth coming in hotter than expected at 0.4% versus the estimate in our survey of 0.3% month over month. Straight away, market reaction. Equities gapping lower. Equity futures on the S&P 500 down by 0.5%, on the NASDAQ down by 0.5%, on the Russell down more than 1%. Turn the page and get to the bond market, and here's your why. Big repricing at the front end, up by 11 or 12 basis points on a 2-year, up 11 on a 10-year as well to 439.81. You have to point out, though, Lisa, when you look at these moves, this is below where we were a week ago, because we had a string of weaker than expected data going into this print, and this bond market rallied hard coming into this morning.
You know, I think that the conversation that we've been having with both Mohamed, the way he's talking about the idea that the weaker data really does point to something that is more sustainable that can't be offset from these numbers. And then Jeff saying, well, this reintroduces the debate really about, are we restrictive? This is the seesaw. And frankly, the markets are kind of tipping it in one way or the other. I mean, that's what we heard from Ellen Zentner, that basically the more enthusiastic this market gets, the harder it is to get to the Fed's goal. So it becomes a sort of chicken and egg race, you know, and this is what's making it really difficult to understand where we're at, because it's like that scientific experiment that we affect the experiment as we observe it. That's where we're at right now.
We shape the events we anticipate.
Correct.
That kind of thing. Can you just imagine Kashkari walking into the 2-day meeting next week, sort of banging the table? Told you so.
Yeah.
Don't we need to have this conversation right now?
Well, he would be right at that moment. And then there are going to be the people who believe what Mohamed El-Erian is saying, which is that if you look at the data, there is weakening coming down the pike, and you can't ignore that. It is a fraught moment. I actually think it's going to be a very difficult debate next week.
Mohamed, we know what you think they should do. Let's talk about what they will do. How is Chairman Powell going to navigate this news conference, given the information we just received this morning?
I think he's going to maintain maximum optionality. He's going to retain his data dependency mantra. And he's going to say, you know, we need more confidence. He's going to use the word confidence and patience, I suspect. And that's it. You know, John, I find it fascinating. Two things I find it fascinating. First, I think it's a shame that we've broken the record of, I think, 28 straight months of the unemployment rate below 4%. That was a nice record to have. But what I find really interesting, and Lisa referred to it and you referred to it, is that the bond market has been much more volatile on the data than the stock market. The downside surprises we had moved yields in a massive way, moved the commodity complex in a massive way, had relatively little impact on equity, and we're seeing the reverse today. And I find this absolutely fascinating, and I would be very curious to hear what Jeff has to say about, you know, this difference in actual volatility between these two segments.
Jeff, what do you make of that?
Yeah, it's a great point. And I think it's explained by this other big topic that in other contexts it would be the only thing we're talking about, and that's the AI boom. And so you look at technology as a share of the S&P 500, it's 43% market cap. This is a different story. I think where you want to see or where you want to look for to see the interest rate impact is in small caps. And I think we'll see that this morning, and a much bigger outcome. And so it's numerator versus denominator. The numerator effect of technology, these incredible amounts of capex and cash flows, is just overwhelming the denominator for that index. And you see that particularly in growth. You see it in the S&P 500 with a very high weighting. So I think that's what explains the higher volatility. You also see it in kind of macro. Look at the MOVE index. Look at interest rate volatility relative to VIX volatility. And the VIX volatility is compressed because you have the tech story. It's also compressed because you have a very low degree of cross-market correlation going on in equities right now. So there are some really important differences going on in the translation of macro data into these indices, and the micro stories going on in equities are as powerful or overwhelming the macro story of the variability that Lisa just mentioned. You know, are we too hot? Are we too cold? That you see reflected in the bond markets every data print.
And certainly the macro environment is whipsaw-y, and we have been talking about the frustration of where to get conviction. Jeff, you really raised this point about this really questions how restrictive we actually are. From your vantage point, does this print of 272,000 new jobs being created in the month of May change your view about the balance of risks for both the Fed as well as for rates?
Well, it's not my view that really matters. I think, will the Fed change its view? And I really don't think they will. This asymmetric response that if inflation slows, if growth slows, and I think the growth picture is going to be as important, the Fed will increase its probabilities. It will want to cut rates for the reasons that Mohamed said. They're more worried about now losing the war. They won the battle on inflation. They don't want to lose the war on the soft landing. And so because of the asymmetry, I think that eases some of the market reaction, the broader market reaction, obviously not from the day reaction to today. So I don't think much has changed there. I think if they were to start talking a little bit more about the concerns about maybe we're not restrictive, if you had more growth data, they'll get the question eventually again, you know, what about hiking rates? He'll dismiss it, and I think that asymmetry is still with us, and I think that's supportive to the financial market outlook, and so I don't think there's a huge change there.
Hey, Jeff, just for the record, we care what you think. We care a lot about what you think.
Absolutely.
Thank you.
This story written yesterday by Rich Miller, our colleague here at Bloomberg. Got to share this with you because there will be some of you out there asking, do these numbers this morning overstate the strength of this economy? Are we measuring things the right way? Is this accurate? Data published Wednesday by the Bureau of Labor Statistics suggests payrolls might have grown about 60,000 less per month on average last year than the roughly 250,000 run rate derived from the agency's monthly employment report. Mike McKee, that question is going to reverberate through the weekend after that number this morning.
Yeah, it's interesting. You're going to have a lot of debate over this because Steve Stanley from Santander points out that we had basically the same situation at this time last year, and then the QCEW numbers, the ones you're referring to, were revised down, and we basically didn't have much of a significant change in payrolls overall. They don't give us the number until August, so we'll be waiting for that. It's just before Jackson Hole. So it may be that it's not as bad as these numbers suggest. But if it is, this doesn't fit with that.
It raises the question, Lisa, are we having the right conversation? It's something we have to think about.
Well, here's the thing you got to worry about. Is the Fed has to deal with the numbers that it has. And so if these numbers come in much weaker when they're revised later on, everybody's going to say, well, the Fed missed it. But they don't know.
Well, this is a reason why, and it's actually wonderful to have Mohamed on. This is a reason why he says this is one of the fatal flaws of data dependency, especially when the data is messy. And that is the moment that we are clearly in.
Mohamed, let's get to it. Do you think we are having the right conversation? Obviously, based on what you've told us over the last few weeks, you don't think we are?
No, look, I think we're having the right conversation based on the data we have. It's very difficult to have a conversation on counterfactual data. But what we are being reminded over and over again is how difficult this economy has become to understand. You know, John, go back to August 2022, the famous 8-minute speech with Payne. Go back to the Bloomberg headline of October 2022, 100% probability the US goes into recession. And then look what actually happened. It just gives you a sense of if you become too data dependent and don't take longer term views, you end up risking real mistakes. And that's what I'm really worried about, John. There are some very clear secular trends going on. Jeff mentioned what's going on in AI. That's one of several secular trends that are going to be with us for a while that we've got to incorporate and stop looking simply at the rearview mirror. You have to both look at the rearview mirror and through the windscreen.
Jeff, final word, your big takeaway?
Well, it's just clearly a big surprise, big downside surprise relative to expectations. July's door is closed, opening the door on a debate about how restrictive Fed policy really is.
Can I just ask you both your best guess for the dot plot next week? 201. 201 on that dot plot for cuts this year. Mohamed, first to you.
1.
Jeff?
Just for contrast, I'll go with 2.
Okay. Jeff Rosenberg, BlackRock, Mohamed El-Erian,
I would have done the same, John.
Appreciate it. I know you would have, because you're trouble, Mohamed. We know that. Jeff is too. Appreciate it, gents. Thank you.
Welcome to our TV and radio audiences worldwide. Welcome to the Labor Department today. We are here with the Acting Labor Secretary, Julie Su. And Secretary, it's great to see you this morning. Thank you for joining us on another Jobs Day. We've got a bit of a mixed signal here in this jobs report. More payrolls than expected and a higher unemployment rate than expected. Which survey, household or establishment, is reflecting reality?
Well, this is another very strong jobs report. I'm not going to get tired of coming here and telling you that we are continuing to experience very strong, stable, and steady growth. So it's 272,000 jobs created last month. The unemployment rate has remained at or below 4% for 30 months straight. That's still the longest since the 1960s. And at the same time, real wages, over the year are up 4.1%. So workers are doing better in an economy in which the president has said, when we focus on workers and worker well-being, we're going to do what's right for the economy and for the country.
When you look under the hood, you find that 400,000, even more than 400,000 people left the labor force in May. The participation rate is not back where it was before COVID right now. How do you explain that?
Well, so let's say, the prime age labor force participation rate remains very, very strong. And it's worth noting that, again, women's labor force participation rate hit another historic high. So last month we said it was the highest since 1948 when this data was begun to be collected. It's now a little bit higher than that even. So women continue to power our economic recovery. At the same time, we are seeing, again, strong participation. People are in the job market. People have come off the sidelines. People are looking for jobs, and they're finding them. Where there has been a little bit of a very small uptick in the unemployment rate. Again, still at or below 4% for the longest stretch in decades. Sure. But has to do with young people ages 20 to 24 who are in a bit of transition, really. If we think about May, right? May is a period of transition for all of us parents with kids who graduate and maybe move and are looking for different jobs during that time.
You can tell a great story and put a great headline number on that unemployment story, as you are right now. But when you look under the hood, you do see some elements of weakness compared to the payroll survey. And I wonder, while you're happy where it is now, if you worry about where we're going to be 6 months from now, if this is a slowing job market.
Well, the payroll survey really is the gold standard when it comes to the unemployment rate, right? This is the, it's the largest by far of any data set, including the household survey, that is used. And so, again, I don't think there's any way to paint this as other than continued strong, stable, and steady growth under President Biden's leadership, and proof of his theory that if we invest in America, we can create good jobs in communities and, crowd in private investment in order to do that. And as I travel the country, I'm seeing the benefits of that.
We've talked a lot about the impact that immigration has on our job market. Can be for better or worse. works depending on the trend that you're looking at. And there's an analysis from Steve Englander at Standard Chartered Bank that we looked at this week that estimates about half of the job growth since October can be attributed to undocumented migrants, that it's somewhere in the area of 109,000 a month. If the president's executive order put in place just days ago lowers the threshold, lowers the numbers of undocumented immigrants entering the country, what does that mean for the job market? Do you see numbers like that in your modeling?
I mean, I haven't seen that study. I would actually question those numbers based on what we see. Right? This is a situation where, one, we're not talking about dividing a small pie into smaller pieces. We're talking about a much bigger pie overall. So more jobs, more people in the labor market, more opportunity for all. Since the president came into office, again, we've talked about this, about 15 million jobs created. That is a 15 million families, 15 million individuals who are having the benefits of a good job that might not have had that before. I would also say that it is true that there has been, immigration-based growth also, and that has been true throughout our nation's history, right? That immigrants have helped to do jobs and help fuel the economy, but the majority of this job growth that we're talking about has gone to native-born workers.
Well, talk to me about the other side of this story, and that's immigration reform. H-1B, H-2B. We spend all day talking about border security in Washington. What does our job market need in terms of attracting talent from other countries legally?
I mean, it's such an important question, right? This is why, since day one, President Biden has called for the kind of comprehensive immigration reform that would address, some of the challenges that our system has created.
What would our job market look like with that help?
What would our job market look like with
if you got that reform? Right.
Well, so we do administer. We have in this administration increased the number of H-2B workers that have come in. We recently did a rule around H-2A workers, making sure that when migrant workers come to this country through legal means, that they're also protected, right? That they are protected for their own good, but also so that their being here doesn't take away from the good wages in those industries. So we, but the bigger picture is that there does need to be comprehensive reform. The president has called for that, and frankly, Congress needs to do its job.
There's something that I don't want to get too deep in the weeds called the birth-death model that our analysts at Bloomberg Economics are looking at that would suggest some of the companies that we've seen closing might not be reflected yet in the numbers that we saw in this monthly survey. Based on layoff announcements, corporate closures, where do we look in the middle of summer when these numbers start to emerge?
Well, we will come out every month to report the data that we have, but everything that we have seen this past month, this past year, as well as the last year since President Biden came into office, is historic job growth. More jobs created during the same time period than any president in our history, and continued low levels of unemployment. Again, historic lows. And more opportunity to come, right? The investments in the president's Investing in America agenda, many of them are still coming out. And that's why this summer I'm going across the country talking about Good Job Summer and focusing on the importance of what a good job does for families.
The Good Job Principles Summer Tour. You're like Beyonce. You're launching a national tour, and it's not a mistake. I see some of the states you're going to, like Pennsylvania and Michigan. What is your message to voters in those states?
Well, my message to working people is that we see you, we have your back. We know that you have talent and desire, and we want to create the kinds of opportunities that will allow working people to have a good job where they can be paid a living wage and live a secure life. And our message generally is that when you build a workforce that is ready, that is trained, that is skilled, that pulls the full talent of the American people, it's good for employers, it's good for our economy, and we see that time and time again in these jobs numbers.
Yeah. Getting back to the household survey, which is important to us and our viewers and listeners, the fact that it reflects agriculture, the fact that it reflects what's happening in people's households, does that not raise the level of importance of the household survey at this point when we look at that against payrolls to get a sense of not even as much where we are now, but where we're going?
I mean, I think the bigger, the answer is the payroll survey is the survey that tells us how many jobs have been created, what industries they've been created in. And again, the growth we're talking about is not just single industry, right? It has been for the entire time, but certainly this last month is no different, very, very broad-based. We saw growth in leisure and hospitality. We saw it in construction. We saw it in professional services. We saw it in healthcare. And so, there's really, the numbers don't lie. It's really, a broad-based, solid, continued growth. And I think that coveted soft landing that so many people bet against.
Well, I haven't even mentioned that yet. It's my job to ask you if we're in the soft landing. I haven't heard words like Goldilocks this morning. What's your broader 30,000-foot view on that? You're looking at your slice of the economy, that's the labor market. Is a soft landing intact?
I think so. I mean, again, it's the kind of thing where we're always vigilant about where the economy is going. But based on where we were, remember, in 2021, right? The president came into office, COVID was raging, there was no national strategy to address it, unemployment was very, very high. People didn't know if they were going to get toilet paper if they went to the supermarket. And now we have historic job growth, low levels of unemployment. I think it is the very definition of a soft landing.
You mentioned COVID. It's not the first time we've brought this up as a barometer, maybe a baseline for where we are now versus where we were before the pandemic. It's still impossible to forecast, isn't it? You see these payroll numbers blowing off the charts based on estimates not just by the government, but by Wall Street and economists who are a lot smarter than I am. When will we be able to get a handle on what comes next?
Well, I mean, I think the reality is that's why we don't look at any 1 month's numbers as over relying on them to tell a story. But the story of this economy from January 2021 until now is of steady, stable growth, shared prosperity, and more investments to come. We know that that there's more work to do. We're also seeing the lowest levels of black-white unemployment in a very long time. So it's equitable growth too, and that matters a lot.
What would a second Biden term mean for the job market?
I think we continue to deliver, right? We continue to build a strong economy. We continue to invest in American industry in a way that hasn't been done in decades. So building, restoring roads and bridges, making sure that every family who turns on the faucet gets clean drinking water, making sure that everybody breathes clean air and has access to high-speed, reliable internet. Those are the kind of infrastructure investments. We want to build the things that we invented, right? So bringing manufacturing back to the United States, I think it means, continued opportunity for the American people.
Will you still be in this building if there's a second term?
Well, I don't want to make predictions about that. I do serve at the pleasure of the president, but it has been an honor to help to deliver on that vision.
Well, I'm glad you could join us on another Jobs Day, and we'd love to meet you back here in a month.
Thank you.
Thanks for the time, as always. The Acting Secretary of Labor, Julie Su.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.